banks got off to a mixed start in 2025.
Bank stocks have performed reasonably well in the last 3-4 months, mainly because investors anticipate, one, a pro-growth agenda by the new administration, and also a deregulatory focus.
There's a lot of optimism around GDP growth and enthusiasm for lending activity within the banking industry.
But at the same time, deposits, a key driver of profitability for banks, are more costly than in recent years.
So as we look to 2025, I think the biggest theme is that while there is a significant optimism around opportunities for increased lending, the real challenge is finding the deposits to fund those loans at an attractive price.
But how exactly do these higher costs impact profit margins? And how are banks making up for it?
For investors, I think the most important thing is just to really understand the drivers. What are the key components of cost? How is that affecting the banks? And then also understanding those dynamics will help investors better understand how banks are managing them.
One of the key components of costs are interest rates.
There's a strong correlation between federal funds rate and the deposit costs. If the rates drop more than anticipated, then the deposit costs would come down commensurately.
In 2022, interest rates started to climb after years of being near zero. In turn, the cost of interest-bearing deposits rose as well.
That's why you see the line increasing. 2024 was a peak, and then it starts to decline based on the interest rate environment.
While costs are expected to decline this year, it's still higher than the previous 5-year average of 0.9%. This puts pressure on net interest margins.
The difference between the loans and the deposit costs determines your net interest margin. So the net interest margin have actually declined a bit, but overall, they should pick up or stabilize at least going forward in 2025.
But while there's pressure on deposit costs, there are other opportunities like lending and M&As.
As the economy improves or stays positive, there should be, for example, higher loan demand. So loan demand from mainly corporate customers, C&I loans, commercial and industrial loans. They haven't grown as much in the last year, 2024, but there's a lot of pent-up demand. There could be more M&A, for example, because of the macroeconomic environment. Companies will want to borrow more money, which is good for banks as long as they're able to provide those loans at a reasonable cost.
So the impact of higher interest rates does not impact all banks equally. What we find is that for regional banks and community banks that have much more exposure to commercial real estate and business loans, which tend to be fixed rate, are much more rate sensitive. While large banks are still impacted because they have a high dependency on wholesale funds, they have more diversified business lines, so they're a little bit more immune to those higher interest rates.
And it's not just size. Business models also play a role.
So there's a bit of a difference between traditional banks and digital-only banks, which tend to have higher deposit rates.
And the competition goes even beyond banks.
Banks are finding themselves competing with other institutions, fintechs, neobanks, new entrants, but equally important is the competition they face from substitutes, which would include money market funds, treasuries, and CDs.
Rates aren't the only way to compete.
Because of the competition in the marketplace, banks are going to have to consider or think about how they create differentiated value for their customers. They don't want to be competing just on rate alone, so it's going to be how they bundle services and create that differentiated value that can allow them to attract deposits in a competitive environment, still profitably while funding the opportunities on the loan side. Banks also have to consider the stability of those deposits. A perfect example of that is when we saw the banking crisis of 2023, when there were a lot of headline events. All of a sudden, the stability of those deposits came into question. So banks that have implemented solutions, for example, using reciprocal deposits, were able to retain those deposits at a competitive cost and demonstrate to the analyst community that they had access to liquidity, so they were more immune to some of those headline events.
So if you invest in banking stocks and you're concerned about how interest rates could impact that delicate balance between loan and deposit rates, remember that experts agree that big banks are the best suited to handle the swings. And there are other opportunities to drive up banks' margins this year.
We are in a relatively uncertain environment, but there's a lot of optimism for growth, and that should kind of drive banks' performance and profitability in 2025 and possibly beyond.